In 2021, Bill Hwang lost $20 billion in 2 days. The largest one-person wealth wipeout in history, and almost nobody could see it coming, because almost nobody could see it at all. Hwang had hidden more than $160 billion of stock bets from the very banks funding them. The trick was perfectly legal. He let the banks hold the shares in their own name, so his positions never showed up on a single public filing. 5 banks each saw a sliver. None saw the whole thing. How do you hide a bet that big? That part is almost better than the collapse. Bill Hwang did not inherit his fortune. Born in South Korea, he moved to the United States as a teenager, studied economics, and landed at Tiger Management under Julian Robertson, the legendary investor whose protégés the industry still calls Tiger Cubs. Hwang was one of the sharpest in the litter. In 2001, he launched his own fund, Tiger Asia, and for a decade it was one of the most respected names in Asian markets. Then in 2012, it all came apart. Tiger Asia pleaded guilty in an insider trading case involving Chinese bank stocks, paid $44 million to settle with regulators, and Hwang was effectively barred from managing money. For most people, that is the final chapter. Hwang treated it as an intermission. In 2013, he took what was left, somewhere around $200 million, and opened a family office he named Archegos. It is Greek for leader. A family office sounds like a boutique with nice carpet. In practice, it is a structure that manages one person's fortune, takes no outside investors, files no public disclosures, and answers to almost no regulator. Just you, your money, and whatever the banks will lend you. And the banks were about to lend Bill Hwang an absurd amount. To understand how absurd, you need to understand the one instrument sitting at the center of all of this. Hwang barely bought any stock directly. Instead, he used something called a total return swap, and the mechanics are simpler than the name suggests. You go to a bank and say you want the profit on a stock without owning it. The bank buys the shares and holds them in its own name. You put up a deposit. If the stock rises, the bank pays you the gain. If it falls, you cover the loss. The bank collects fees for the privilege and gets to call you a valued client. Now look at what just happened to the paperwork. The shares sit on the bank's books, not yours, so your name never lands on a public filing, and no regulator ever watches the position build. Now do that with 5 banks at once. Each one could see exactly what it had lent him. None could see what the other 4 had done. Take a breath, because this is the number that matters. Archegos held roughly $36 billion in actual capital. Through stacked swaps across those banks, Hwang quietly turned it into more than $160 billion of market exposure, from $200 million to $160 billion in 8 years. Leverage stacked to the very edge of what the system could physically hold. So where did $160 billion of bets actually go? Into shockingly few places. For all that financial engineering, Hwang's actual strategy was almost old-fashioned. He picked a handful of companies he believed were undervalued and bet enormous sums they would rise. He spread it across a short list of names: ViacomCBS, Baidu, VipShop, Farfetch, and Discovery. Each position swollen far beyond what a normal fund could carry. At one point, Archegos secretly controlled more than half the freely traded shares of ViacomCBS, and almost nobody knew, because on paper those shares belonged to his banks. The banks were not innocent bystanders in this. Prime brokerage is lucrative, and lending to a billionaire who keeps winning is more lucrative still, so they competed for his business and kept handing him more rope. Nomura reportedly gave Archegos roughly 4 times the leverage a normal fund would ever get. Everyone was making money. Everyone was happy. That is usually the exact moment to start worrying. Because winning on that much borrowed money only works while the stocks cooperate. In March 2021, one of them stopped. Quick one before the floor gives way. If you're finding this useful, subscribe. This channel pulls apart the machinery of big money that normally stays behind closed doors. Right, back to the margin call that ended it. It started with ViacomCBS doing something completely ordinary. In late March 2021, the company announced a new share sale to raise cash. More shares means each existing share is worth a little less, so the price softened. For a normal investor, a few percent is a Tuesday. For a fund leveraged the way Archegos was, a few percent is a margin call. The banks rang and asked Hwang to post more collateral. He could not. Nearly every dollar he had was already committed to the same handful of stocks now sliding in unison. Therefore, the banks did the only thing they could to protect themselves. They started selling the shares they were holding in his name. Goldman Sachs moved first, dumping more than $10 billion of stock in a single day. Morgan Stanley moved almost as fast. Credit Suisse and Nomura hesitated, tried to coordinate an orderly unwind, and lost the race. By the time they sold, everyone was offloading the same names into a market with no buyers left. ViacomCBS fell 27% in a single day. Discovery fell about the same. The selling fed the selling. More than $100 billion of market value evaporated across Hwang's positions. Bloomberg put his personal losses at $20 billion in 2 days. The Wall Street Journal counted $8 billion over 10. Argue the figure all you like. Either way, it is the largest personal fortune ever destroyed that fast. And the man who built it was the least of the casualties. Because the banks did not just lose Hwang's money, they lost their own. Credit Suisse took the worst of it, $5.5 billion, and had to raise nearly $2 billion in fresh capital just to steady itself. It fired 9 staff, including its chief risk officer and a top investment banker, and clawed back $70 million in bonuses. Nomura lost $2.85 billion. Morgan Stanley, $911 million. UBS, $774 million. Mitsubishi UFJ, around $300 million. Added up, and the lenders lost more than $10 billion between them, all because none of them could see what the others were doing. Deutsche Bank, by contrast, read the room early, closed its position fast, and walked away clean. The difference between losing billions and losing nothing came down to one thing: speed. As for Credit Suisse, the wound never really healed. Archegos was not the only reason a 167-year-old bank eventually failed, but it was the moment the market stopped trusting it. 2 years later, in 2023, Credit Suisse was swallowed by its old rival UBS in an emergency rescue. Which left one question for the courts: what exactly had Hwang done wrong if the instrument itself was legal? In April 2022, Hwang was arrested and charged with racketeering, securities fraud, wire fraud, and market manipulation. Prosecutors argued the swaps were not the crime. The lies were. To keep the banks lending as his positions ballooned, Hwang and his chief financial officer, Patrick Halligan, had repeatedly misled them about what Archegos actually held. In July 2024, a jury convicted him on 10 of 11 counts. In November, he was sentenced to 18 years and ordered to pay more than $9 billion in restitution. At sentencing, the judge asked Hwang's own lawyer how her client compared to Sam Bankman-Fried, the FTX founder, then serving 25 years for an $8 billion fraud. Her answer was telling. Bankman-Fried, she said, was outright stealing from his customers. That was not what happened here. And she had a point. Hwang did not run off with anyone's deposits. He used a standard Wall Street product, offered freely to wealthy clients, that happened to come with a blind spot the size of $160 billion. So circle back to that quiet Manhattan office. One man did not outsmart the system. The system handed him a tool that could hide a $160 billion position and cheered him on until it blew up in everyone's face. Hwang is in prison. Credit Suisse is gone. And the disclosure gap that hid all of it, the one that let a single-family office go undetected until the damage was already done, is still sitting in the system today, exactly where it was in March 2021. If that doesn't unsettle you slightly, watch the next one anyway. I break down the money machinery nobody else will. Subscribe, and I'll see you there.